Large caps and mid caps form an integral part of any equity portfolio. While large caps provide stability, mid caps boost return. Of course, one can add small caps to the mix as well for the extra kicker. Now, if you want to invest in large and mid caps in a definite proportion through a single fund, categories like multi-cap funds and large and mid-cap funds make it possible. But if you want to invest passively in large and mid-caps in a definite proportion, until recently this wasn't simple. You had to invest in a large cap index fund and in a mid cap index fund in a definite proportion and then rebalance your portfolio from time to time to restore that proportion. This rebalancing would have likely resulted in a tax incident as well. Well, those days are now gone thanks to a new index that lets you take a definite exposure to both large and mid caps within a single fund. It's the Nifty Large Mid Cap 250 Index, and yes, there are funds available for this index, so it's very much investable. Hello and welcome to ET Money's YouTube channel. Today we are going to analyze the Nifty Large Mid Cap 250 Index to see if it packs a punch. Now, this is not the first time we are analyzing an index. We have done that in the past as well whenever we felt index looked promising. I mentioned the links of our index related videos in the description. After you have watched this video, do check them out as well. Okay, in this video, first we will explore the construct of the Nifty Large Mid Cap 250 Index and see what sets it apart from the rest. Then we will evaluate its performance and volatility across periods. Finally, we will look at its risk-adjusted performance. To get the most of this video, I would recommend that you watch each and every section. Only then you can figure out if this index is the right fit for you or not. Alright, let's start with the construct of the Nifty Large Cap Mid Cap 250 Index. As the name suggests, this index comprises 250 large and mid cap stocks. It is a composite of Nifty 100 and the Nifty Mid Cap 150 indices. So there are 100 large caps and 50 mid caps in the index. But there is a major difference between this index and the others. It has 50% weightage each to large and mid caps. So that means 50% weightage to the stocks from the Nifty 100 and 50% to those from the Nifty Mid Cap 150. But why does it matter, you may wonder? Well, if it were to be based on free float market cap of the stocks involved, 80% of the index would have been large caps and only 20% mid caps. Now, if you're not sure about this free float market cap, let me explain. Free float market cap is the market cap based on the number of shares that are normally available for trading and hence which are comparatively more liquid. It excludes illiquid shareholdings such as those belonging to the promoters, governments and trusts. Now, most indices are based on free float market cap. That results in the biggest companies getting a lion's share in the index. Now, that's where the Nifty Large Mid Cap 250 Index is different. It assigns 50% weightage each to large and mid caps. Now, what that means that at any point in time, it will have 50% each of large and mid caps. The table on your screen compares the weights of the top 5 stocks in the Nifty Large Cap Mid Cap 250 Index versus the weights as per the free float method. So, for example, HDFC Bank forms 5.6% of the Large Mid Cap 250 Index. If this index were to be based on free float market cap, HDFC Bank would have formed 9.3% of the index. And eventually, large caps alone would have constituted 80% of the index, giving it a large cap heavy texture. But that's not so with this index. So you can be assured of a definite large and mid cap exposure at all times. And it resets its portfolio quarterly to restore the 50-50 large mid split. But is it worth it? And where does this index lie in the risk reward spectrum as compared to large cap, mid cap and small cap indices and the active large and mid cap funds? We will see all this next. But before that, an important reminder. The tax saving season is going on. The ET Money app and website is your one-stop destination for tax saving solutions. Here you can invest in ELSS funds, NPS, health insurance and life insurance and get all investments proof at one place. To measure the performance of the Nifty Large Mid Cap 250 Index, we use a metric called average rolling returns. To find average 5-year rolling returns, we average return across all 5-year periods. This gives us one number. This number is the most likely estimate of how a fund has performed over any 5-year period in its history. We can similarly find average 3 or 7-year rolling returns. So we check the 3-year, 5-year and 7-year rolling returns of the Nifty Large Mid Cap 250 Index and compare them with the rolling returns of the Nifty 100, Nifty Mid Cap 150, Nifty Small Cap 250 and active large and mid-cap funds. The results are on your screen. Please remember that 3 years is not the right time frame to invest in any equity fund. We have considered it only for the sake of analysis so that we can get the medium-term picture. Now, if you want to invest in any equity fund, you must have a time frame of 5 years or more. Now, to understand the returns picture better, let's convert these returns into relative ranks. So, the larger the number for a rolling return period, the lower the rank. In relative terms, the Nifty 100 has the worst return profile. It ranks either 4 or 5 across all time periods. That's understandable as this index comprises large cap stocks, which has a lower return profile. But the reverse of this statement isn't true. The small cap index is the second worst performer across time spans. The best performer is the mid cap index and the second best performer is active large and mid cap funds. Our Nifty large mid cap 250 index has a middling performance when it comes to returns. It has ranked 3 on 2 occasions and 4 on 1 occasion. But return shouldn't be the sole criteria. Volatility of those returns matter as well. So let's take a look at the volatility picture now. To measure volatility, we use a metric called standard deviation. The higher the standard deviation, the more the volatility. So we measure the standard deviations of the rolling returns of the Nifty large mid-cap 250 index across the periods and compare them with the standard deviations of other indices and active large and mid-cap funds. See the screen for what we found. Too many numbers, right? Let's convert them into ranks as well. Here, the lesser the standard deviation, the better the rank. On expected lines, the Nifty 100 is the least volatile and the Nifty mid and small cap indices are the most volatile. The Nifty 100 ranks 1 or 2 and the Nifty mid and small cap rank 4 or 5. The Nifty large mid cap 250 index does a good job at limiting volatility. It ranks either 2 or 3. It's even better than the active large and mid cap funds for 3 and 5 year periods. So while return wise this index is somewhere in the middle, volatility wise it is perched towards the top. Now to get a full picture, let's combine the performance and volatility pictures and arrive at what we call as risk-adjusted returns. Okay, first a quick introduction to what risk-adjusted returns are. When you invest in an asset, you take a certain risk for a certain return. The sweet spot is a situation where the risk is limited but the returns are good. The worst case is when the risk is high and the returns are low. So to get the right picture, you should look at the returns from the lens of the risk that you are taking. That's the concept of risk-adjusted returns. Now to find the risk-adjusted returns, we divided the rolling returns across periods by the standard deviation of those rolling returns or the volatility of those funds. The higher the number so obtained, the better. Let's convert them into ranks for better clarity. The higher the number, the lower the rank. Let's first talk about the Nifty 100. It comes at the top for 3 and 5 year period. It means while you're getting comparatively lower returns, the risk involved is even lower. So risk adjusted returns are high. But over 7 year period, the Nifty 100 loses its charm. Nifty mid and small cap indices are mostly at the bottom. While the Nifty mid cap index has a higher return profile, the volatility or the risk involved is even higher. So the risk adjusted returns are low. The Nifty small cap index is a major disappointment. It has comparatively lower returns but higher volatility. So it's a raw deal. Now active large and mid cap funds do a decent job. They're in the middle over the 3 and 5 year and at the top for 7 years. But the best among this lot is the Nifty large mid cap 250 index. Across all time frames, it ranks 2. So while its returns may not be at the top, the risk it takes to deliver those returns is low. Hence, the risk adjusted returns are high. Now, given its risk return profile, the index is worth exploring. But don't take our word for it. It isn't a recommendation. If you're interested in this index, you must do your own research before investing in it. As of now, 2 index funds based on the Nifty large mid cap 250 index are available. Number 1 is Edelweiss Nifty large mid cap index fund and second is Zerodha Nifty large mid cap index fund. Now, whether you invest in this index or any other fund, don't forget that ET Money lets you invest in mutual funds without any commissions. And you can track all your investments at one place with ET Money. That's the cherry on the cake. And with this, we have come to the end of this video. If you liked this video, do share it with your friends and family. And I'll be back with another video soon. Till then, take care.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.